Hi, I'm Richard Vague with Tycos. Is President Trump going to fire Federal Reserve System Chair Jay Powell? If so, and Federal Reserve independence is threatened as a result, what will that mean for financial markets? Let me start by saying we like and support the idea of Fed independence, but as we will show in future weeks, not for the reasons others give, and our view is neither a defense of Powell nor a criticism of President Trump. Most of what you hear about the Fed is the responsibility it has, the so-called dual mandate to curb high inflation and maximize employment. But that's not even close to the reason the Fed was created way back in 1913. In fact, those duties were not even added until over 60 years later in 1977, a point at which OPEC was beginning to punish the U.S. with high oil prices. So what is the Fed? It's a bank, albeit a special purpose bank. And like most other banks, it extends credit, usually in the form of the bonds it purchases, and takes deposits from its member banks, which it calls reserves. How big is the Fed? Well, it's the biggest bank in the country by a wide margin. How big? The Fed now has $5.8 trillion in assets, and its current massive size is a fairly recent phenomenon that came about with the rescue of the economy in the global financial crisis, followed by another rescue in the COVID crisis. Here's a look at the ratio of the Fed's assets to GDP from 1915 to the present, which is an easy way to compare the relative size of something through time. You can see it was actually shrinking in amount from the years after the Great Depression and World War II, and that shrinking continued all the way until 2008. Yet, in spite of its new large size, it is still relatively small as a percent of GDP when compared to the world's other major central banks. The European Central Bank, in which, when we look at it, we include all the individual central banks in EU countries as part of that. China's PBOC, People's Bank of China, the Bank of England, and the Bank of Japan. The Fed's size is only 20% of GDP as compared to 128% at the Bank of Japan. In fact, it's smaller right now on an actual dollar equivalent basis than Europe's central bank system and the PBOC. By the way, please note how small the vaunted legendary Bank of England is compared to the other major central banks, an illustration of the shrinking importance of the UK in the global economy. The Fed has been able to shrink from 37% of GDP to 20% of GDP over the last few years by selling bonds or allowing them to mature, something called reverse QE or quantitative tightening, QT, and it plans to shrink further, though in our view there's no imperative for the Fed to do this anytime soon, if at all. Another thing to note is the Fed's profitability, which was always good up until recently when, in coping with the global financial crisis, it decided to start paying interest on the reserves banks keep with it. It did this to encourage banks to hold more reserves with it for two reasons. First, as a measure of safety for the banks. After all, that's one of the reasons the Federal Reserve Bank was created, to force banks to keep some portion of their funds safely tucked away at the Fed in reserve. And the second reason is the Fed's belief that paying interest on reserves helps maintain the federal funds rate close to its stated target, which at the time this was enacted was on its path all the way down to 0%. In any event, the Fed used to earn good money, positive earnings, which it passed on to the Treasury. But since September of 2022, it has lost money. The Federal Reserve loses money because it pays this interest, currently 4.4% interest rate, something it calls the IORB, or the interest on reserve balances rate, on the bank's reserves. At the very least, it means the Treasury is no longer receiving a nice chunk of revenue each year as the Fed's earnings are dividended up to it. Instead, those earnings are now going to banks in the form of that interest that's being paid. Senator Ted Cruz, among others, has advocated discontinuing paying interest on reserves, something that was almost never done historically, and we tend to agree with him. Note that the Fed's equity doesn't drop when it posts losses. So let's examine for a moment the Fed's equity, which is an important component of any bank. It doesn't drop when the Fed posts losses because instead the Fed books each loss as a deferred asset, giving the Fed the right to keep future profits until the shortfall is fully recovered. So every loss is matched by the benefit of retaining those future earnings rather than remitting them to the Treasury. This is fairly unique and different accounting that you should take note of. And with that accounting technique, the Fed reports his capital as a positive $45 billion, which is really a tiny slice of a $5.8 trillion institution. It's effectively no capital law at all. But in addition to this, in its S61 schedule, the schedule of all assets and liabilities at the Fed, it shows its net worth as over negative $1 trillion, which is mostly the valuation changes in the Fed's balance sheet as opposed to just its realized losses. It's an astonishing number. Given all this, let's take a moment to talk about why the Fed was created. The U.S. did not even have a central bank for nearly 80 years, from 1836 to 1913. And that was a period in which the U.S. bypassed both Britain and China in size to become the world's largest economy. The U.S. had no central bank, and by the way, the U.S. dollar was not the world's reserve currency, and yet the U.S. became by far the largest economy in the world, even though these two things were true. It kind of makes you wonder. And in fact, it should tell us something about the necessity of those two things. And by the way, the U.S. did not really have any inflation of consequence during that extended period, other than obviously in wartime. But it did have a series of financial crises after the Civil War. Major banking crises in 1873, 1884, 1893, and in 1907. These crises related largely to the periodic manic and massive overbuilding of railroads, which was by far the country's dominant non-agricultural industry for that century. And the result was massive amounts of bad debt from banks and others lending to these railroads, and an onslaught of banking failures and stock market panics, as they called them in those days. The sticking point for these crises was that the country had the embarrassment of having to rely on J.P. Morgan to rescue it in the last two of these. J.P. Morgan had to engineer the propping up and bailing out of troubled banks in its role as the so-called lender of last resort. This lender of last resort role was a role that had come to be fairly clearly understood in Britain through the rescue actions that the Bank of England had had to take in its many 19th century crises. And that was the very role, the crucial role that the Fed so assertively and successfully took in the 1987 crisis in the U.S. and the global financial crisis in 2008. Ultimately, that is and remains the most important purpose of the Fed. So, back to this 1907 crisis, Congress, both fed up and scared, passed the Aldrich-Vreeland Act to create emergency currency for use in future crises, a power that was used successfully just a few years later in the crisis that came with the start of World War I, the 1914 crisis. It also created a commission to study the possibility of starting a central bank. And it did this by studying the Bank of England, Germany's Reichsbank, and other institutions. That would result in the Federal Reserve Act of 1913 and the Fed we know today, which we will discuss a bit more next week. That's it for now. Thanks.